the first one of the hot button kind of topics that we saw over the course of this week was a consumer slowdown, kind of hinted at by Walmart and Home Depot. We have been monitoring economic conditions broadly, given the fact that the NASDAQ, again, was down around 33% in 2022, but it started 2023 with a bang, up over 13%, almost 14% at one point. And our question that we're mulling over is whether or not the market move is sustainable, or this is just you're throwing it, it's your dead cat bounce. One tool that you can look at, now this is by no means scientific, but it gives you a broader idea of where the outlook of some of the top CEOs from the largest retailers. You look at some of the outlooks from the largest retailers are, including the likes of Walmart and Home Depot. This week, Walmart came out with expectations for the year, as did Home Depot with their quarterly numbers. Walmart easily topped expectations for their holiday quarter, but it gave a weaker than expected outlook for the year ahead. Home Depot, for its part, issued kind of similar guidance. The home improvement retailer, which also reported its fourth quarter fiscal results this week, said it planned for flat same-store sales going forward over the course of this year, as stubborn inflation and climbing interest rates cause consumers to watch their spending. To quote the Home Depot chief financial officer, he said, "We've seen an increasing degree of price sensitivity as the year has gone on, which is actually sort of what we predicted in the face of persistent inflation." I mean, that would be something that seems very logical, and that happened over the course of, and particularly into the fourth quarter of 2022. And now they're seeing that going into 2023. Again, the significant price increases of everyday goods, including food, this coupled with higher mortgage payments at present or on the horizon, should lead to a weaker consumer, particularly on discretionary items. This is not great for economic growth near term and can hit the stock market. However, one could argue on the flip side that the declines in 2022, with the hit we saw in the markets there, that hit has already come in the markets. The markets have already anticipated that and taken the valuations lower. But if you look at current valuations, they are still not on the historically high end. They are on the historically high end. So caution for us would remain. I would say discretionary retailers are likely in a tougher position than, say, the Walmarts and Home Depots of the world. So like Macy's and Nordstrom in the US, public companies that are skewed towards discretionary goods, apparel, handbags, shoes, and those things. Those two companies have already warned about their holiday results. So that would be their Q4 results for those companies. In the cases of Walmart and Home Depot, they both sell consumer staples largely, particularly Walmart, so they should fare better in a recession. What I worry about on these companies generally is the fact that in terms of Walmart and Home Depot, they still trade at premium multiples. Walmart is still 24 times forward earnings, and Home Depot is 18.2 times forward EPS, with earnings expected to be lower this year. So no growth, actually lower earnings this year. So, I mean, those would be my thoughts on the news that came out from Home Depot and Walmart this year, or just this week. You guys got any comments on that?
Well, Walmart certainly is going to be a good barometer for the overall economy. And I don't think it's much of a surprise. Most people are expecting that we're going to go into some kind of a recession. Really the question is, how long is the recession going to last? Is it going to be short and shallow or long and deep? And that's really what matters right now. I'd say the market seems to be expecting what would be referred to as a soft landing, so that short and shallow recession. But I've noticed a lot, I mean, just from reading the conference calls of various industries, I mean, we're definitely noticing slowdown for sure. Like in the tech space, for example, several tech companies that we cover have companies that have been able to produce consistent double-digit above 20% growth year over year are saying that, their customers are starting to pull back on spending right now. They're seeing lower levels of growth, most still growing, some, generating or expecting more flat performance, but definitely that customers, so companies, are starting to really look at their budgets and being more careful about how much they spend. There's commentary from some of the tech players that have the biggest challenge they've had over previous years has been hiring tech talent. It's been really hard to hire people, and wages have been going up. Now they're slowing down hiring. Another sector as well that we're looking at, we've followed for years and have made recommendations in the past, would be trucking. So there's, over the past couple of years, shortage of drivers, a lot of upward pressure on prices. So trucking companies have benefited from that, but now we're seeing the reverse. There's some downward pressure on prices. So we're definitely seeing this reverberate through the economy. Not a surprise. I mean, I would be shocked if we don't go into recession. The question is, how long is it going to last? So right now it seems that inflation is trending in the right direction. And if it continues to do that, maybe 6 to 9 months, the Bank of Canada and the Fed in the US starts to talk about lowering interest rates. If that happens, all of a sudden, or we get a couple interest rate declines, then, we might start to see some adrenaline get pumped back into the market. Now, a lot of these companies are thinking, for example, in the tech space, that things are going to recover in the latter half of 2023 or in early 2024. But really, that's just speculation at this point. I mean, nobody knows. But what they are saying over the next couple quarters is they're definitely seeing, a big slowdown in growth, tightening of budgets, and that's gonna affect the bottom line.
Yeah, for sure. I mean, it's something we have to monitor closely, and it's to the extent, like you said.
But I'll just add, though, I don't think that this affects or should affect or impact investment decisions, really, because the fact of the matter is you can't predict what's going to happen with the macroeconomy. Even if it's trending in a certain direction right now, there's so many moving parts to that equation. It's really to predict where the economy is going to go in the next 1 to 2 years that's a fool's game. You're not going to win that game at all. I don't believe anybody does long term. So really what you want to invest in good, solid businesses that you want to own for 5 years plus, and that you're buying at a reasonable price, companies that are essential, companies that are solving important problems. Those are the types of businesses that the world is going to need regardless of what happens. They may see lower growth, even a decline in revenue and cash flow in the near term, but those are the businesses that are going to come out of any recession even stronger. And if we do have a soft landing, then the impact to a lot of these companies may be quite muted.
Yeah, and that is because forecasts are for idiots, really. And like
Really,
we
yeah.
could be
Which
talking
is why we
about,
made a bunch of forecasts at the beginning of the year.
which is
But
what
we
the
also
half of
admitted
them,
that nobody should
they're
ever
for
listen to
idiots.
them,
Yeah,
or they
basically.
should not inform any investment decisions.
Yeah,
What is it?
it's true.
A good forecaster makes a lot of forecasts because, like, you're
Yeah,
just throwing.
you make as many forecasts as
Yeah.
possible, so that by the probabilities, 1 or 2 of those are going to be
Yeah.
correct, and then you just talk about the ones that are correct, or you predict something for long enough that eventually it comes true. Like, a
Yeah,
certain
I
commodity
happen to see a
increase in price.
presentation.
Yeah, and then you start talking about how you've been, a long-term bull in that area.
Yeah.
We see it all the time. Don't listen to forecasters.
I saw a presentation recently where there was bullish on these things, bearish on that on the same slide, and it was bullish on about 15 to 20 things, bearish on about 15 to 20 things. And I could almost guarantee the speech next year will be, I'll come back and I'll highlight the 3 that I was right on each side, and look how much of a hero I am. For us, that's not the way to be doing it, and it also doesn't predict it doesn't prove that you can predict anything.
Yeah, I mean, what you want from the forecast is to judge it is, could you actually have used the entire forecast to generate a solid investment return in excess of just, investing in the index or whatnot. That's the real test, right? So there's a lot of people that have made forecasts. Sometimes they're correct, but they were not investable. Sometimes they were not correct and also not investable. So
yeah, there's many forecasts that are with the consensus that you're not going to make a profit off them anyways, because the market is already using the consensus. All the investments that are made are on the consensus. So
or you could say something is going to happen, so stay away from it, but you could say, advise to get into something else, and that also doesn't work out, right? So net, the person is still not benefited from using the forecast.